Shiv, hi, good morning. Good to have you on the show. I was just looking at the year-to-date performance for India, or for that matter, even month-to-date, and we continue to outperform not just our emerging market peers, but on a quarterly basis, we've managed to even outperform what US equity markets have done. What's leading to this outperformance, you think?
Well, thanks for having me back again. I think there are two big factors here. One is that post the second wave, businesses in India have demonstrated a remarkable resiliency. And that is now starting to get factored in to the fact that in case there is a third wave, perhaps that will still be the likely outcome. I think the second is we're at the start of this, but global investors are realizing that China is a much more difficult and complicated place to do business than probably one realized. And in fact, the MSCI China has underperformed MSCI India for the last 5 and 10 years, despite a lot of the negativity on India and the positivity on China. And to me, that's on a global level, that could be a fundamental change that could happen over the next couple of years. If global allocators decide that India deserves a slightly higher weight in their portfolio compared to the past versus, say, China.
Interesting. So one wonders, Shiv, for India equity markets as well, where from here we're already at a base of 60,000 for the Sensex as of, before the choppiness last week kicked in. We were just 100 points away from 18K on the Nifty. Do you sense this market has more legs to go before we call it a day? And more importantly, at what phase of the bull market you think we're currently at? Because many believe, while we're not at the early stages, but they believe that the bull market has a long, long way to go before we call it quits.
Well, I think experience has taught us that we never call it quits. There are only temporary periods where there's turbulence, and that could last a couple of years. But structurally, there's still a long way to go, as you point out. Well, look, I think India right now is in a little bit of a sweet spot, where a lot of the reforms that caused a lot of pain over the last few years, well-meaning reforms, except maybe one, had a negative economic impact. And that usually takes a few years. We took about 4 or 5 years to get a banking system in order. But I think the banking system largely now looks in very good condition. And that is great for credit growth when credit demand does revive. I think the overall economy is reviving very well. We're also starting to see a move in employment towards more formal sectors. And this is primarily driven by the gig economy. But that is also a positive long-term trend. The other positive long-term trend I see is that demand for IT services professionals in India. And I don't think that's cyclical. I think that's going to last for a very long time. And the reason for that is globally, every business has realized after the pandemic that they need to be digital first. And when that happens at a global level, there's not enough supply of IT services professionals. The other important aspect is that these companies have gotten comfortable with their important IT work being done remotely, which is never the case before. They want it all on site. And so if it's being done remotely, well, they're comfortable with it getting done remotely from India. And as a result, more higher value projects are getting outsourced. So we could see a renaissance of IT services employment, let alone demand. That again has second and third derivative benefits and consumption in India over the long term. So quite a few positive things. I think the one thing to keep in mind is really inflation, and that's a global issue. And it hits India through oil prices as well as through energy, the energy basket. And that could be a global issue for next year, whether inflation is cyclical or it's more persistent. The worrying part there is globally we see wage inflation, which tends to be more sticky than some of the product price inflation.
Good morning, Shiv. This is Nantara. So I was on your website, and this is what I read about your investment approach. Let me just read it out for my viewers. We focus on identifying high-quality companies that can become compounding machines and compound earnings at healthy rates over a long period of time. You then talk about finding companies and businesses with a greater moat where there are very few competitors. Now, you've talked to us about IT, digitization of work, remote working. These are not businesses that are going to have few competitors. This is where everybody's headed. So let me ask you this way: where are you seeing the compounders at the moment in India?
Yeah, so I want to make a couple of first points, and then I'll can talk about some specific areas where we're seeing that. Number one is that at a high level, the pandemic has broadened the divide, I think, between large companies that have the ability to invest in technology and smaller mid-cap companies operating in the same space that don't have that kind of budget. I mean, we know in financial services, there are certain large companies, their IT budget for the quarter is basically the operating profit for a small or a medium-sized bank or NBFC for the year. And that divide is becoming critical now, which may not have been as important in the past. So it's very important to be cognizant of where one looks first to find those compounders. Second is, I think the compounders have to have a tech-first mindset, because the moat can only be built through that now. It's no longer about just having growth for growth's sake. It's really about having a tech advantage. And I think third, all of that should translate into pricing power to determine the strength of the business, especially if you're entering an era where inflation is going to go up. Where do I see that? I mean, in the consumer sector still continues to be the case. The consumer sector has been overvalued for 15 years and people have avoided it, but it's still been a very fertile source of compounding for a long time. You're seeing the largest consumer company in India, and the CEO is basically talking tech all the time, whether it's supply chain, whether it's customer obsession. They're redesigning their outlets so that they focus first on what the customer wants rather than just fulfilling an outlet. And they have scale. So we're seeing enough opportunities in that area. In financial services, same thing. The structural trend in financial services, when GDP per capita is $2,000, is not over. It's impossible. There's a long runway to go. The key issue is to be focused on companies that have built that moat in financial services by using technology. It's no longer just about having the lowest cost of capital and good risk management. That is essential, but that's not enough anymore. And then finally, in tech, for the first time, we're seeing companies that are just outside of pure IT services. I mean, we've just had a company list in the NASDAQ that is a SaaS product company. And I think it's remarkable that we're seeing product-first companies being accepted from India globally. And given the cost advantage and the scale advantage, these could be big, big businesses in the years to come.
So you like consumption stocks, even if they're overvalued? You've talked about IT, and I take the point about the Freshworks IPO, which has, of course, created 500 crore, put these back home. The founder did tell ET now that. But Shiv Puri, you started by saying be cognizant of where you're going to put the money between the large caps and the mid caps, because the pandemic has made men bigger men, right? That's the sense I got from what you were saying. So with that, what's your outlook as far as the broader markets go? Because markets like to look forward as well.
Clarify that earlier comment of yours. But, I think overall, in the broader market, we're seeing very exciting things both in the public and the private space. And in the public space, it's a lot of the companies that are in the pipeline to go public, in the technology space, especially. Now, one can say, look, I mean, I don't like the valuations now, and maybe in the future they'll be more palatable, but the business models are certainly very, very attractive. And I think some of these areas that I talked about in consumption and financial services, these businesses are never going to be cheap. And I sort of draw the analogy to the US tech stocks that have generated immense value for many years. And the reason is because they're compounders, because they are actually have really strong dominant franchises. And as a result, if the longevity of earnings growth is there, these stocks will trade at a reasonably high multiple, and that's okay. Um, I think the areas to be careful about are primarily two. One is public companies that are being seriously challenged by amazing entrepreneurs who are still private, and they don't know how fast the change is coming to hit them. So, and there are a lot of public companies that fall in that bucket, especially in the mid cap space, but even in many in the large cap, well-known companies in the large cap space. And I think that's one area one needs to be careful about. And the second area I think one needs to be a little careful about is in tech, when companies are using shareholder capital to subsidize and get consumers, but they don't really have a strong business model. But broadly, I think the markets are looking pretty healthy, given the construct and the backdrop, especially in the context of the rest of the world.
Sure. So where are the new opportunities, Shiv? I mean, if I were to ask you that in the last 3 months, what is it that you've bought and sold? What is your portfolio construct looking like? Or maybe add more.
Well, without talking about any specific names, I think broadly it's around the themes that we've talked about. As you know, there are certain areas that we just don't know as well, which tend to be in the manufacturing, infrastructure, heavy capital investment areas. But I think there's not much that's happened out there that's too exciting over a long-term basis. If you look at the cycle over 10 years, very few stocks have actually compounded, which is a key criteria of how we look at companies. But broadly in the areas of consumer, financials, tech, and healthcare, especially in some of the hospital names, there's been a fair bit of activity, and I think those areas continuously look very promising for the years to come.
Sure. When you say tech, how optimistic are you about, I mean, you were just alluding to Freshworks and some of the other IPOs as well, but there's going to be a slew of them. And, be it whatever business, it has a tech flavor to it. Most of them being platform companies, niche at that. Just wanted to understand, what is it that you're making of as to what parameter to really judge these slew of IPOs with? Because, you saw during Zomato that many believe that you've got to doff a hat of a PE investor. You can't really look at, traditional metrics like valuation when trying to analyze these companies who are not money making now, but look at what they're going to do 10 years ahead from us, or even further than that, perhaps. How do you sense one needs to really analyze these new age businesses making their way into secondary markets?
Yeah, I like to first look at things on first principles. And a lot of companies sort of throw words around tech and platform. And of course, now it's all ML and AI. And sometimes there's no justification for any of it. And so on first principles, I think it's important to understand what exactly does the company do? How does it really leverage technology? If there's an offline business that has a website, is that a tech business? I don't think it's a tech business. I think it's just another channel for them to sell their product or market their product. And so I think it's first important to understand what constitutes a tech-powered business. And to me, that means that the business can find a proprietary source of data which it can sensibly analyze, and that the growth can be exponential and nonlinear. They don't require incremental capital for a unit of growth. And if they achieve enough scale doing that, then the barrier to entry for the next player becomes quite high. So it's not something easy to do. And we feel that there are very few companies that are able to actually do that. Now, what is looked for is really trying to figure out the management team first, because business plans for all these tech companies have to pivot very quickly and very often. World's changing too fast to stick to a 5-year plan for any of these tech companies. So their ability is paramount. The second is whether they do actually have the chops for technology innovation, whether it's in their DNA. I mean, you mentioned a company that just went public recently. I would say companies like that do have, but many others don't. I think the third is to understand the unit economics of the business. Does it even make sense? Or is it just going top line growth and doing more deliveries or selling more products online? But the unit economics almost would never add up to what's required. And so I think when you put these 3 or 4 things together is when the recipe comes together to look for a company that might fit that long-term compounding machine in the tech space.
Truly tech, with a truly tech-first mindset, not just the instances of maybe just increasing your IT budget. And, like you were pointing out earlier as well, make that as one of the screeners, if you may say so, for identifying a compounder. But Shiv Puri, just to go back a little bit to the macros, just the way the foreign investors have been pumping in money, we've seen that rise, particularly in the last 2 months, the story change that's come about, coupled with the retail investors' penetration. The recent rally that we have seen is also on the back of retail investors, more SIP flows, more demat accounts, and all of that, which is opening up, with many experts saying that this is going to be India's decade. However, there seems to be caution that is ringing in because of global events. How are you looking at all of this, when you've got an energy crisis on in China and Europe, when other assets start doing better, you're seeing the property markets come back also in India?
Yeah, so, there are a couple of different facets to that. The first is what we're talking about is macro, which to me the biggest risk out there would be through higher interest rates, because inflation in the West goes up, oil prices go up, and therefore India has to follow suit too. But I think it's important to keep in mind that it doesn't necessarily mean that higher interest rates means, definitively lower stock prices. I think that's a very important distinction. Sure, your discounted cash flows mean that the cash coming later on is worth less, but there's also the other metric, right? The numerator, which means if business is really strong, your earnings are going to be much higher. So even if you discount that at a higher rate, your net result might still be better. So I think it's very important to understand that aspect. And in the past, we've seen in India, rising rates can also lead to rising stock prices. So that's one important aspect, I think, to keep in mind. The other thing which you're talking about, retail flows, I think there's good retail flows, and then there's sort of new retail flows. And this is a global phenomenon, whether it's with Robinhood or our version of Robinhood in this part of the world. But that is something that I think is, it never has ended well in the past. It probably won't end well. But it does seem that a lot of the activity that happens on those kind of retail platforms don't typically tend to be the sort of high quality, semi-boring, long-term compounders, but tend to be a little bit more, what's the flavor for the week and the flavor for the month. So I think things like that can get hurt from time to time. But fundamentally, to me, the only real macro issue is on inflation and correspondingly interest rates. A minor rise, a gradual rise, I think is something that can be handled. A significant catching up by the Fed because they are behind the curve. If that is the scenario, that is something that could derail things for a while.
Isn't it? That is inflation transient, or is it structural? It's going to be interesting to get the RBI governor's comments later this week during the Monetary Policy Committee. But Shiv Puri, it's been an absolute pleasure having you on the show. Thanks so much for joining us here so our viewers can figure out how to figure out companies and stocks with greater moat, the compounders, as you call them. With that, ladies and gentlemen, we're going to take a short commercial break. Coming up on the other side, one of the hottest stocks, M&M, and the top management will be joining us.